The price flashes on screens across New York, London, and Shanghai. $50 per ounce. For a moment, it looks like a breakthrough. Silver, long overshadowed by gold, is finally reclaiming its place. But then, almost instantly, the number begins to flicker. $40, $20, $47.80, $45. Traders hesitate, industrial buyers pull back. Somewhere, deep inside a data center, an algorithm starts selling fast. Within hours, billions in market value evaporate. This isn't a glitch. It's not a rogue trader. It's something deeper. Because silver is no longer just a metal. It's a battleground between two forces pulling in opposite directions. One sees it as the backbone of the green energy revolution, essential, scarce, and undervalued. The other treats it as a financial instrument, leveraged, traded, and often detached from the physical reality it represents. So the question is no longer whether silver will rise or fall. The real question is this: which version of silver will define its future, the one you can hold in your hand, or the one that exists only as a number? To understand where silver is going, we have to go back, not to a trading floor, but to the foundations of modern money. For most of human history, silver is not a speculative asset. It is money. Empires rise and fall on its supply. From the Roman denarius to the Spanish pieces of 8, silver forms the backbone of global trade. It is trusted, tangible, and finite, but its dominance contains a hidden flaw: supply instability. When vast silver deposits are discovered in the Americas, Spain floods global markets. Prices collapse, inflation spreads. The very asset designed to stabilize economies becomes the source of volatility. This is the first paradox of silver. By the 20th century, governments move away from silver. Paper money replaces metal. Central banks prefer gold. Silver transitions from money to commodity. But unlike gold, it takes on a second identity. It becomes industrial. Silver is the most conductive element on Earth. That single property makes it indispensable in a world built on electronics. Think of it like this: if electricity is water, silver is the smoothest pipe you can possibly build. It allows energy to flow with minimal resistance. That makes it critical in everything from smartphones to solar panels. Initially, this dual role, part monetary asset, part industrial input, appears to be a strength. Demand is diversified. But over time, this becomes a structural tension. Industrial demand doesn't behave like investment demand. Manufacturers buy it because they have no choice. Investors buy because they expect it to rise. This creates a market where two fundamentally different logics coexist and often collide. By the late 20th century, financial markets transformed silver into something else entirely: abstraction. Instead of moving bars of silver, traders exchange contracts. A futures contract is essentially a promise. Imagine a warehouse with 1,000 ounces of silver. Now introduce futures. Suddenly, traders create contracts for 100,000 ounces. This is leverage. The price is no longer determined solely by physical supply, but by the volume of financial contracts. The system works until it doesn't. In 1980, the Hunt brothers attempt to corner the silver market. Prices skyrocket, from under $10 to nearly $50. But the system pushes back. Exchanges change the rules and prices collapse. Fast forward to 2008, a credit crisis erupts. Silver prices crash, even as long-term demand remains intact. Then 2020, a pandemic halts production. Supply chains break. But investors flood into metal seeking safety. The price of paper silver diverges from the cost of physical silver. Dealers run out. Premiums surge. Today, silver sits at the intersection of two powerful trends. First, the global push toward renewable energy. Solar panels require silver. Electric vehicles, 5G infrastructure, and advanced electronics all rely on its properties. Industrial demand is reaching record highs. But much of the silver used is not economically recoverable. It's effectively lost. Mining output is not keeping pace. New discoveries are limited. Extraction is expensive. This should mean higher prices. But the financial layer complicates everything. ETFs and futures markets continue to dominate price discovery. Silver is more essential than ever, while its price remains influenced by a system that can expand supply artificially. Imagine a scenario where industrial demand accelerates, investment demand spikes, and supply is disrupted. If enough participants demand delivery of real metal, the system faces a stress test. Leverage makes it fragile. Today's market is about liquidity, leverage, and trust. This same dynamic appears across all of modern finance. Silver is not unique. It is a blueprint, a system where abstraction enables scale but introduces hidden vulnerabilities. So how do you analyze it? You don't start with price charts. You start with structure. First, watch the ratio of paper claims to physical supply. Second, monitor industrial demand in solar and electronics. Third, pay attention to inventory levels in vaults. Fourth, track macroeconomic conditions, interest rates, and inflation. Markets are not neutral. They are shaped by participants with competing objectives. The future of silver is a complex interaction. And that brings us back to the flashing number. That drop from $50 to $45 wasn't just volatility, it was a signal. One grounded in atoms, the other in algorithms. Silver doesn't care about sentiment or speculation. It conducts electricity. It enables technology. And when the tension becomes too great, the system resets. The future of silver is a story about the limits of financial abstraction. Once you see that, you're watching the system itself.